Hi, everyone. Welcome to Typhon Capital Management's Q3 2017 Outlook call. You've got most of our portfolio, I think all of our portfolio managers here. Most of them are on video, some of them are dialed in. Basically, we're going to talk about what we did in Q2. It was a pretty good quarter for the firm overall, where we see things going in Q3 here. And there we go. Sorry, it was weird. I'm watching like Clue just sit there as I talk. But anyway, for those of us who aren't too familiar with Typhon as a firm, what we are is a deconstructed multi-strategy hedge fund where we've got 7 different teams of portfolio managers. They all trade really niche, uncorrelated strategies. If you look at kind of what we do here as a firm. Every manager that we have is single-digit correlation to every other manager, and pretty close to that on both the S&P and New Edge. The one exception here is Leonidas, who George runs 2 strategies, the macro, which invests in energy, and approximately 40% of the macro book is energy, hence the high correlation there. But all of our strategies are available in separately managed accounts, and we also have both U.S. and Cayman fund platforms. And one exciting thing for the firm is starting in October, we're going to launch some pure security strategies, and Matt and Mike Thompson will be able to speak a little bit to that going forward. But we're going to start off with our CIO, Dave Klusendorf, and he's going to kind of walk us through all of the managers here, and we're going to start off with Jared Lehman, who runs our Proteus grain strategy, which had a really nice June. So go for it, guys.
Well, everyone, welcome. Jared, why don't we just start a little bit with a recap of last month, what you saw in the grain complex. More importantly, where your thinking began with the wheat trade and how that developed to construct it out of Minneapolis.
And actually, Jared, sorry, before you answer that, I got to give a disclosure that this is being recorded and is going to be broadcast on the website. So if you don't want yourself potentially recorded, either don't say anything or please drop off now. God, I hate lawyers.
No, okay. Yeah, last month, we got started in a wheat trade that we've been trying to construct for a few weeks, and Minneapolis exchange is a little bit in as far as the market, but we have a huge reach of farmers up as well as commercials up in the Dakotas and into Montana as well. Have several millers that buy a lot of wheat. We knew that protein from the hard wheat crop was an issue due to some of their weather that they've had, and so we were watching the spring wheat crop probably just a little bit closer than we normally do this year. It started getting a little bit dry. We knew that the demand for spring wheat was going to be strong, and it's also inelastic. We knew that acres were probably going to be down, and just visiting with farmers and commercials and Indians like up there, had people driving around up in the Dakotas, and we knew that acres were down. Also up in Canada, talked with a couple outfits up there that it gave us kind of an early tip that acres might not be quite as high as what some people had been thinking. So we were watching that, and as the weather started to get dry, we were able to get some spreads on, and also some options here that I think, quite honestly, I'm not sure if the spring wheat thing has even really begun. So I think the next, a few weeks to a few months, we could see the major move of that ahead of us yet. Harvest is just getting ready to start in South Dakota. A lot of those acres have been cut and baled. There will be a lot of abandonment this year, much higher than normal. The government came out here last week with their first spring wheat acreage and did decrease the crop size, but left abandonment about the same. and quite frankly, their numbers on yield are still way too high. So this is might go down as the worst, if not probably the second worst crop next to 1988. And I guess our feeling is we've got a minimum of 10%, maybe up to 25%. You know, the government may be that much too high yet on this crop with stocks already tight. So, you know, we think this could be kind of a 1 in 5 to 5 year move in the spring wheat complex. We all remember what it did back in, you know, 6-7 years ago when it ran to $25. I don't know that we go there, but the potential for one big move ahead of it yet is still there. So I'm very excited about that.
Do you think it's going to spread too, Jared, you know, throughout the entire grain complex, or do you think wheat's going to be the hardest hit out of all the crops?
Well, it's interesting. I think Minneapolis is soon going to kind of not follow. I mean, the other wheats will not follow Minneapolis. I mean, this is a protein story. It's a protein issue. Just talking with a miller this morning, we've got guys out of Canada calling around millers for some of the mid stuff. I think Minneapolis wheat's going to kind of separate itself from the other wheats. Some of the dry weather, though, we're starting to see dry weather creep into Iowa, especially western Iowa, Nebraska. Some of their dryland corn has been hurt pretty bad. These next couple days of rain coming across are going to be crucial. You know, they missed those, and we are going to start taking a lot of this crop size off. So, you know, I think right now I'd put the corn crop probably in the 160 to 165 area, and the real potential to creep under 160 is there. And I think that's when corn could become pretty interesting too and get pretty tight. On the soybeans, I think soybeans are well behind normal. Now, that's not to say with good August and September rains, which we've seen the last 2 years, we can't still produce a very good soybean crop. But with the government using a 48 type yield, you know, you shave 2-3 bushels off there, and all of a sudden a beans in the teens type of scenario is pretty realistic again. So, you know, the dry areas are expanding. This high pressure ridge is coming in next few days. Moves out east for a few days and then moves back out west. So these next 2-3 weeks of weather are going to either make or kind of break this crop.
Awesome. Thanks, Jared. Really appreciate it. Really great work last month.
Thank you.
All right. Well, why don't we move on to Damien and talk a little bit about the DAX. It was an interesting month, and July is already off to a roaring start. So, Damon, can we give a little background on what you see going forward here, you know, with the DAX?
Sure, Clue. Hi, guys. Pleasure to be on the call. Yeah, as you mentioned, obviously June was a toughish month for us. Volatility just got smacked in the DAX. Was sub 10% most of the month. You know, the average DAX vol is around the 20% level. So down at these levels, you know, it's tough for us to really eke out decent numbers. But you know, we had a good April. You know, it was flattish May, but June did trip us up slightly. But as you've mentioned, yeah, we've had a good start this month. Vol has crept up a bit. We had a decent sell-off a couple of days back that we were short for. We're currently running, just to sort of take a step back, the algorithm takes a view on the sort of market conditions we're in. We're sitting on a bear tack. Its view is that markets should be looking to sell off a bit. That caught us out a bit last month, but this month has worked pretty well. Market is up 1%, but we caught some of the rally at the beginning of the month and then some of the drops that have come so far. So we're looking up about 1% so far this month, which is great for us. You know, headline-wise, I think there's some negative Deutsche Bank stories that are around, which are helping weigh on the DAX. I think we could see a sell-off through the rest of this month, maybe into August, before we might start to look for a turnaround there. But you know, as we sit, you know, volatility, you know, vol for us around the sort of between 15 and 17% is sort of our optimal level. So we're slightly below where we'd like it at the moment, but you know, the model does adjust to try and counteract that. So we tend not to bleed too badly during those those low vol areas, and hopefully we get some sort of pickup. We're pretty confident of a good finish to the year.
All right. Appreciate it, Damon, very much. As long as we're overseas, why don't we move on to Nick? Nick runs the Chiron FX strategy. Nick, you've been sending back some interesting articles back and forth a little bit. Can we get an outlook as far as where you see? Why don't we start with just activity in the currencies over the next 3 months?
Oh, I probably have to unmute him, huh? One sec. Okay, Nick, you there?
Hi, can you hear me now?
Yep.
Yes. And just, by the way, for people watching at home, you're seeing Nick in like kind of a green phone-looking icon, but basically it looks like a Cold War spy if there was a picture up of him. So just have that in your mind as he talks about currency.
The green phone icon is better looking than me.
Yeah, baby. I don't know.
Okay, so the market is currently pretty short of the dollar, and I think the reason for that principally is that pretty much every central banker who's been wheeled out in the last 2 to 3 weeks has once again reiterated a course of gradualism rather than any great changes in policy. And the problem with FX at the moment that has made it really pretty tricky for us all year is that FX valuations have moved away from their traditional drivers, which tend to be inflation differentials and interest rate differentials, real rate differentials to cut it down to one line, to one where basically each currency has, it seems, been allocated a risk profile. So when you have a risk-off day, the yen catches a bid, and the Canadian dollar is offered. And there are so many different combinations that seem to exist out there that reflect the market's view on risk rather than anything else, that there's no real theme. Sure, over the last 4 to 5 months, the dollar generally has been weaker, but on a short-term horizon, it's been very flaky trading. So the way we see it going forward over here is that I think there's likely to be a short-term correction in the dollar against pretty much everything else, just because positioning is so overextended one way. But I think ultimately what you will see is a strengthening, certainly of the euro, probably dragging cables kicking and screaming along with it, but a more generalized weakness in the dollar overall.
Thanks, Nick. Appreciate it very much. Let's move on to Leonidas or Michaelopoulos with not only the energy. We're going to kind of lump the energy and the macro together, George, and get your viewpoint. Why don't we start first with the energy viewpoint, and then how that's leaning in towards the macro view of things and what you're seeing as far as that program.
Oh, got to unmute him too. Okay, go for it, George.
Okay, so I was talking to myself there for a while.
Yeah, just like
I do that anyway. Yeah, it's my good. So yeah, I was saying both the oil and the macro outlook for me are starting to converge.
George.
I think we've lost.
Well, that's anticlimactic.
All right, well, let's circle back then.
But
why don't we?
Hold on, he just said that I muted him.
Okay.
That's wrong. Shit. One sec, sorry. Perils of live internet TV. Okay, wait, try again, Georgie.
Can you guys hear me again now?
Yes, sorry. I thought it was really
Okay,
fascinating about the alignment of the energy and macro outlook.
Yes, so sorry. So a couple of themes playing out. I think a tension between sort of very low compressed vol and intraday sort of realized vol, which in some markets like, let's say NASDAQ over the last couple of weeks has compressed massively, as well as sort of some outlooks, whether it be, catalysts, whether it be geopolitical or otherwise, making sort of some fat tail, I think, minefields out there, but and just making it very difficult to sort of, I think, be responsibly short vol and collecting theta. And again, having this sort of bifurcated outlook in general in the macro space. And the same thing translates over into energy, where from a traditional metrics perspective, the market looks quite bullish with big draws in a weak spreads. It seemed very ripe for a swing upwards, but even with 10 million barrel draws over the last few weeks, every week, you're not, and good healthy demand in today's numbers, for example, you're not really able to see these big moves up into the 50s, and that's because of the competing sort of short tail side of things, which is the continued uptick in domestic production and the potentially regime changing implications of shale as they continue to play out, and the implications for Q4 versus now. And what that means for weaker spreads and an oversupply potentially in WTI in particular. So again, you have this sort of tug of war happening between, I think, these two fat tails, which should be ultimately very bullish vol, but timing and not bleeding to death is going to continue to be the challenge in the macro side and on the energy side. So I'm actually long vol, which can be a very painful position to be in for quite some prolonged periods, and you see spikes up, in sort of the actual realized vol and price moves to justify those positions. So you tend to get paid pretty quickly when it happens, and just mitigating the fate in the meantime is the challenge. So that's how I feel about both the energy side and the macro. The themes that I'm really interested in on the macro side, aside from the vol side, are the sort of tension that I see with cyclical inflation in Europe having been probably or underestimated by Draghi and company, and the implications that it makes for the euro as a currency, which I think I also believe should probably get stronger as that cyclical inflation starts showing up and potentially shows that the central bank is slightly behind the curve, or have been overly dovish. And so the currency and potentially the bonds need to sell off as the market aligns with that understanding in the next few months. And the implication, of course, that has on the dollar, given the dollar is a large part euro, is that, it probably needs to weaken. And so I think at the same time, we're in a disinflationary sort of regime in the United States in particular, with market labor participation and all the long-term trends that we're already familiar with, and that many market participants have actually overestimated, which is the opposite of what I said about Europe, the inflationary forces in the United States. So one of my favorite trades right now that I'm just putting on is long U.S. Treasuries and short German bonds. So to express that view, and I expect the currencies to reflect a similar story, sort of a balance of risk in those two sort of places, in addition to the long vol tension that I think will ultimately be a very big winner. So that's kind of where we're at.
You talked a little bit about patience and everything, and I know what a challenge that can be. Can you expand on that a little bit from just a pure trading point of view? When that becomes a key word for you, how do you express that patience and keep that discipline with what you're doing?
So yeah, I keep an eye on things like realized versus implied vol, and I try to understand what the different distributions in price and returns are in the different regimes. So if regime one is status quo, which means slow grinds up in almost all the equity markets, for example, while you wait, then instead of hedging as frequently to the upside, for example, and selling futures, again, delta hedging, in other words, as price goes up every day, you might wait 2 or 3 days of 0.3% moves to do that and sort of try to mitigate that bleed from a small delta and less frequent hedging to the upside to try to pay some of the bill, but there's still inevitably a theta. And yet at the same time, when the time comes where you see a catalyst or price starts to move in a way that doesn't make sense, as we saw, was it last week or the week before, NASDAQ, where you're getting 2.5% moves down with no real news or catalyst. You have to be quick to try to maintain that convexity and be fully hedged and try to ramp up risk on the long vol side. So it's a very risk on, risk off, jerky type of positioning that you have to maintain when the market's so willing to sell vol so quickly, and the vol of vol itself is so low because it continues to be compressed, and people see any vol spike as a selling opportunity. And again, trying to, while the status quo in those non-vol environments persist, make use of the understanding of what that means for price for the most part, which is like those longer grinds up, for example, to try to mitigate your losses in data space. But ultimately, with all those words and all that theory, at the end of the day, if you want to maintain a ton of convexity, which is what makes the beauty of long vol beautiful, you need to be prepared to pay, and you just need to continue to monitor the forces underlying why you're long vol to begin with, whether it be fundamental fat tails like I believe in, but also in the day-to-day, the realized vol that's going to pay your theta bill versus the implieds. So I'm not sure if that answers your question or not, but that's sort of how I think about it in this kind of market.
All right, thanks, George. Really appreciate it. And that's going to make a nice little segue over to Matt and Mike Thompson, our Proteus guys. Why don't we talk a little bit, since we've seen an all-time low this week in the in volatility in the VIX contract. Why don't we talk a little bit about what that really means? I go back to like to sell 14s and buy 24s, one of the first conversations we've ever had. How does that play in with the Proteus strategy?
Thanks, Clue. We share a lot of the same views currently on equity volatility as George does. We're carrying positions that kind of get us along that convexity. Just the whole equity vol complex, has really been beaten into the ground as the short volatility trade and the willingness to short volatility as kind of income replacement, return generator has really become popular. The lens of a flat price in volatility, I think, will get the volatility tourists that sell vol on every bump in trouble at some point if we get a vol follow through. So we do like to carry futures spread positions that get us long convexity and try to pay for the cost to carry, while nothing is happening.
Right. Yeah. So, just to put some numbers around it, the prices in the VIX curve are basically zero, all-time lows or fifth percentile. So the levels are really low. The vol of the price movements of those futures is very low. So you're about 25th percentile there. This is going back to 2004. So you got real low, quiet curve. At the same time, the steepness in the curve, which represents the decay, that's about 75th percentile. So you're pretty steep, low curve, but so your kind of status quo day would be a couple tick bleed in the futures, with that trap door sort of always lurking around the corner. When vol's real low like this, it can easily pop up to a more normal level quickly. So as I'm just echoing Mike's sentiment there, we're trying to put on, and the system's telling us that we need to have some convexity, some long exposure in here too, while we're sort of waiting for those trapdoors.
James, I want to circle back to Mike and Matt to talk about the security side and tackle Gallo first. Why don't we move over to James?
James Gallo.
James Gallo.
It's a little trickier when I don't have their pictures. Who to unmute? Gallo, are you good?
Hey guys.
What's up? So again, just like we missed the KGB looking spy with Nick earlier, with Gallo, we're missing the big New Jersey guy who likes to show up for board meetings fresh from the gym. So a little context.
Do it one time. You had to make
forever, Gallo, forever.
What's
James,
going on?
Why don't we talk a little bit about the gold position you guys have on right now, what you're looking for from that, and what idea that's expressing.
Okay. Our position right now is we're long front end, short further down the curve, and our thinking right now with this position, we're coming into the tail end of our roll period over the last 2 weeks of it, in fact. And our position is based on one simple core that we're looking for a large speculative short position in gold. Over the last week and a half, where we were sitting around at 12.15, the position was outstanding, and it's still working quite well, but we've seen about a $25 rally in the gold market. That seems to be caused by part of it actually is the additional short open interest, with really no news cycle, only really the interest rate talk and the weak dollar at this point caused a slight rally in it. We are still taking some profits in the trade. We're just cutting our expectations down to where they were at lower gold prices, spot prices. So overall, we feel it's a good trade as we continue to unwind it. We were hoping for a little bit more on the downside in gold, but we're still able to churn a nice little profit on the trade, and we're still in the process of unwinding it, as I said. But as we get to these lower levels of the gold market, where there tends to be less open interest, it's one of the core tenets of our strategy, being long front, short be further down the curve. In particular, we love it in any markets where there is physical problems or where there is a large speculative short open interest. So we're kind of standing by our guns in our traditional strategy that's helped us build the track record we have over the last 10, 12 years or so.
Awesome. Before we get into Matt and Mike and the security side of things, I'd like to open things up to general questions for any of the managers now that we've gone through everybody. James, will you moderate that, please?
Yeah, sure. It's unmuted now, so if anyone wants to ask any questions or heckle us or really whatever, just say so, or just go right into it.
Hi, this is Thomas.
I know you.
Hi, James. How are you? Guys, I just wanted to ask one question about the Vulcan Metals Fund. You just spoke about a 10 to 12-year track record. Was it in the strategy and the fund was set up in 2011, or what exactly do you mean by the track record?
Well, so
James, you want to jump in on that?
Sure. Our head PM on that, James Gallo, I mean, has actually been running the strategy for, for more like 30 years. But the first 20 of them were on the floor, which is, somewhat different than screen trading. He's been screen trading at about 10 years, but we only have the data prior to, or I guess post the MF Global bankruptcy, since, for obvious reasons, we can't get that statement data, prior to November 2011. But the track record you see here is proprietary pro forma for fees through May of 2016. And then we started client trading in June of 2016. And then the fund itself launched in March of
March 6th or so, March 6th or something.
Yeah, just in time to miss like our monster first week of March. But yeah, the fund's been off to a nice start here.
Okay, perfect. Thanks.
You're welcome. Any other questions? Okay, well, Cleo, you want to talk to the Thompsons about the Proteus Dynamic ETP Fund?
Mike and Matt, you back on?
Yep.
Yeah, we're here.
Let's talk about the Proteus Dynamic ETP Fund.
Just rolls off the tongue.
Yeah, it sure does, doesn't it?
Right,
Who thought of that name?
As the name would imply, that the strategy uses all exchange traded products that are in the vol family, and volatility itself kind of crosses over the future side of the business as well as the SEC side of the business. VIX options are SEC products, or VIX futures or CFTC products. So we wanted a vehicle where we could use more of the instruments that are in the volatility complex. So there's a kind of more fine-tuned exposures and positioning that's available with the exchange-traded products on the vol side, as well as option strategies. We can hang around the core strategy. So all the signals are built off the same assembly line, and we do use a discretionary component where Matt, uses some discretion in weighting the signals and the construction of the trade for the signals. So Matt can talk a little bit more about that.
Yeah, so I mean, I think the big difference between using the ETFs, on a cash basis and trading futures is that, especially with a 10% margin equity cap like we have in Proteus, obviously that limits exposure to a certain degree. On the cash side, we'll use between 0 and 100% of the cash in the portfolio, typically about 25 to 50% of the portfolio in cash and exposed to the ETFs. So the exposure can range, and it's more aggressive than Proteus. There's no leverage involved, but it's just the cash exposure is greater. So, we've been running this live with client accounts since October 2011, and on a cash-on-cash basis, we've annualized at about 26% for 5.5 years, and it's due in large part just to the fact that we can use a bit more of the portfolio, and in some certain instances, a lot more of the portfolio without ever using any leverage. And it's interesting, just a little thing like if we want to be short some part of the VIX futures curve, there's an ETF we can go out and buy that does that for us. And when so we're long an ETF that has short exposure underneath the hood, and it's interesting the way those exposures evolve over time. If you're short something, your exposure goes down as the trade goes for you. On the cash side, if you're long an instrument that is going for you, it's getting actually larger in the portfolio, so that the compounding of positions is completely different between the two products. And I think as a sidelight, we do report the track record to Morningstar ETF Managed Portfolios database, which is about just about 1,000 portfolios, and that has recently been ranked number 1 on the 1 and 5-year return across all those portfolios. It's a good return source. It's not correlated to stocks. It's very similar return source to Proteus, and it's just expressed in a different way.
Yeah, and then we'll be publishing that track record and more information about the fund structure in next month's newsletter, with anticipated launch of October 1st.
All right, that just about wraps it up on my end, James.
Okay, well, we got any other further questions, or speak now or forever hold your peace? Okay, well, thank you everyone for joining us. It's always fun to talk to everyone, and we'll talk to you soon. Thanks.
Thank you. Good luck trading, everybody.